Good morning, good afternoon, and good evening to all the audience connected. We are going to start with the first virtual session of the 36th Conference of Central Banks and Official Institutions about Global Investment Views with the first-class speaker, Jan Hatzius. To take advantage of the time of these sessions, I'm going to make a very brief introduction. Jan is the head of the Global Investment Research Division and chief economist at Goldman Sachs. He has a PhD in economics from Oxford University, as well as degrees from the University of Wisconsin-Madison and the Kiel Institute for the World Economy. Please, for more detail about Jan's extensive career, I invite you all to see this complete bio on the event site. Mr. Hatzius, it's a pleasure to have you here.
It's wonderful to be with you all, and thanks so much for participating in this conference and listening to what I have to say about the global economic outlook. And I should start really with the top topic, namely inflation. And I should start with, by acknowledging that inflation has continued to be substantially higher than we and I think many other forecasters had expected. And I think that's true really throughout large parts of the global economy, less so in Asia, but definitely more so in the rest of the world, including the advanced economies of Europe and the United States. You will have seen the latest September consumer price index for the US, which once again came in ahead of consensus expectations. So definitely a very substantial inflation problem that central banks are addressing, still in the process of addressing. I do think, though, while the numbers have been substantially higher, I am confident that this is not the inflation problem of the 1970s, that we're not moving back into that period or that kind of entrenched inflation. I think there's a legitimate debate about the path from here for inflation. There's a legitimate debate about the amount of interest rate increases that are going to be required. And there's a legitimate debate about whether we will need to see recessions and how deep those recessions are going to be in the places where there are recessions. But I think there is no real possibility of inflation getting entrenched at a much higher level because the central banks are not going to allow it. So I do think that there is disinflation ahead, one way or the other. I think it's going to involve a recession in Europe. In the United States, I think it's more of an open question. Our baseline is no recession. So if you take a look at where we have, and I'll start with the US, where we expect inflation over the next year or so, or year and a quarter, here are our forecasts for the headline consumer price index, which is now at 8.2% after today's number, peaked at 9.1% a few months ago. We have that coming down to the sort of 2.5% to 3% range by late 2023. For core inflation, core PCE inflation specifically, which is the measure that the Federal Reserve looks at most, we're currently at about 5%, peaked at about 5.5%. And we expect to be in the 2.5% to 3% range by the end of 2023, with much of that disinflation occurring because of the goods sector, both energy and food, which are obviously outside the core indices, and then within the core indices, things like furniture and used cars and apparel and other core goods areas where we're already seeing clear signs of disinflation. In the consumer price index this morning, which again was higher than expected overall, nevertheless, in core goods, we had a flat reading, and in overall goods, we had a small decline because of the decline in energy prices. So that's our basic forecast. Now, how do we get to that forecast? I think on the goods side, it's a relatively straightforward story where, we have seen a very substantial amount of dollar appreciation. The dollar is up, about 12 or 13% year on year on a broad trade-weighted basis. That is starting to feed through into lower core goods prices. And we've seen, a substantial decline in energy prices. There's been some backup recently on the back of the decision by OPEC plus Russia to reduce production quotas by 2 million barrels per day. Obviously, very controversial decision, which the Biden administration has criticized. There has been some backup, but so far that backup really hasn't moved the needle substantially. And nevertheless, we're likely to see the contribution from energy prices to headline inflation go from sharply positive to neutral and eventually negative as you're comparing with higher and higher year-ago prices. So I think that's a relatively easy call that we're likely to see, continued helpful contributions, disinflationary contributions from both commodity prices and the dollar. I think it's also very likely that we will see continued improvement as far as supply constraints are concerned. The other really big driver of goods inflation, especially in core goods, and the auto sector is a really key part of this, because we've seen a large improvement in what we see from business surveys on changes in delivery lags in the purchasing managers indices like the ISM survey or the European PMIs or the PMIs that we get for most economies in the world. There's one component that we think is particularly helpful, which is the change in delivery times, which was running at extremely high levels, meaning large increases in delivery times, about a sort of 6 to 12 months ago. That was in the context of ongoing depletion of inventories in areas like new and used cars, which you see on the right-hand side. But recently, there's been a very substantial improvement in those measures, which is really only beginning to feed through to the official price indices. But I think we'll still see a large amount of improvement there. I think it's much more complicated to determine what the path is for service prices from here. Goods prices will continue to disinflate and probably deflate to some degree, at least in the United States. Service prices, I think, more complicated. I think on the plus side, we have seen the most important category of service prices, namely rents, which are used not only to measure the housing cost of renters, but also the housing cost of owner-occupiers through a rental equivalence measure, which is known as owner's equivalent rent. In reality, we have seen a clear deceleration in rent growth. If you look at new rents on new leases, we've seen a large decline there in the growth rate, as you can see in the red and blue line on the left-hand side of this chart. This is the Zillow Observed Rent Index and the apartment list asking rent measures. This is basically the question of whether asking rents are rising or falling, and there's been a big deceleration. I think that deceleration is still ongoing. We are seeing declines in demand for rental apartments, and we're seeing increases in the supply of multifamily units, as you can see on the right-hand side. Housing starts for 5+ unit buildings, meaning basically apartment buildings, have been quite strong, and there are very large numbers of homes under construction in that market, as developers have basically taken advantage of very high rents and therefore very high margins. So I think there is a strong reason to believe that rents are going to continue to decelerate and probably fall to some degree over the next several months. However, what shows up in the consumer price index is a much more lagged version of these prices that we see in reality. The gray line is the consumer price index for rent of primary residence, and that has continued to accelerate and is something that probably still will be running at very strong levels even as we go into 2023. I think there will be an important debate about whether we look at this much more lagging measure of rents or at the more sensitive market measures of rents that are that we're seeing deflate at this point. So, I think ultimately the biggest question is probably, though, not what happens with the different components of the CPI and the PCE index, but whether the overheating of the US labor market, it can be brought under control. And I think the labor market is overheated. And I think the best way to measure the overheating in the labor market is really through this chart, which is our way of conceptualizing the gap between the total number of jobs and the total number of workers in the labor market. Total number of jobs we define as employment plus job openings, and the total number of workers we simply measure via labor force participation. And as you can see at the on the right of this chart, we had a huge increase in job openings in particular, and therefore an unprecedented gap between total number of jobs and total number of workers 6 months ago. We still have a big gap, but this gap is coming down. And I think the Fed's goal is basically going to be to close this gap, to bring down job openings relative or total number of jobs relative to the total number of workers. And I think that that they will view this as a return to equilibrium in the labor market. Now, are we making progress in this jobs workers gap? We are making progress if we look at the most recent numbers for the jobs workers gap. Our estimate is that in March of 2022, the gap was in absolute terms about 6 million, and that it has come down to 4.3 million over the last 6 months. We're also estimating that in order to get wage growth to a level that is consistent with the Fed's 2% inflation target, we would need to see a further decline by 2 to 2.5 million from here. So we're on a pretty good path, I think, in terms of closing the jobs workers gap, really mainly via a decline in job openings. And we think that that is probably going to be helpful in re-equilibrating the labor market. Ultimately, the goal is going to be to reduce wage growth to levels that are more consistent with the Fed's inflation target. We measure wage growth by averaging effectively a number of different indicators. The employment cost index, average hourly earnings, and a measure of wages for individuals on a 12-month basis that's calculated from the Household Survey of Employment by the Federal Reserve Bank of Atlanta. That's the dark blue line here. And that measure has been running at 5%, it's the light blue line. It's been running at about 5.5% over the last few quarters, with maybe a hint of deceleration in the most recent observation in the third quarter. And then we also look at basically wage surveys as leading indicators for what happens with actual wages. And for that, we simply average all the employer side monthly wage surveys that are available mostly from the regional Federal Reserve banks. And if you look at what's been happening over the last few months, there's been a pretty clear deceleration or decline in this diffusion index effectively, which would point to a slowdown in wage growth to maybe the 4.5% range from the 5.5% range. I don't think 4.5% is enough. I think ultimately we'll have to come down further to maybe 3.5%. But if we were to see deceleration to 4.5%, that would be, I think, a pretty good step. Now, what does all this mean for Fed policy? Our expectation is that today's CPI certainly seals the deal for another 75 basis point rate increase at the November FOMC meeting early next month. Beyond that, we're looking for 50 basis points in December and then a final 25 basis point rate increase at the February meeting. That is not far from current market pricing, although after today's upside surprise on the CPI, the market is now pricing something in between 50 and 75 for December. That's probably reasonable because it certainly could be 75 basis points if we get further disappointing news on inflation. That said, I think if you look at what Fed officials have said, for example, in the most recent set of FOMC minutes that came out yesterday, they do want to go to a level that they view as restrictive on monetary policy. So whether that's 4.5 and 4 to 4 3/4, or 4 3/4 to 5, or a little over 5%, they want to go to a restrictive level and then hold at that restrictive level, even if inflation is still above the target, because they are aware of the lags of monetary policy and want to see how that plays out. So I think if the inflation numbers are still too high in the early part of 2023, as they almost certainly will be, I don't think that necessarily means they will continue to tighten at every meeting, because they'll be quite aware of the level of inflation, the level of interest rates already at a high level as well. Now, one question obviously is, as the Fed tightens monetary policy further, how much of a hit to economic activity is that going to mean? And does it basically doom the economy to a recession in 2023? Now, it's certainly true that higher short-term interest rates have led to much tighter financial conditions, and that is delivering a sizable negative impulse to growth, and will continue to do so, and probably somewhat bigger negative impulse as we go into Q4, Q1, and next year. And the way we like to look at this is via our financial conditions index, which is a weighted average of short-term interest rates, long-term interest rates, equity prices, credit spreads, and the dollar, with weights that are proportional to the level, to the impact of shocks to each of these variables on GDP growth over the next year. And the right-hand side basically shows how much of a drag on growth we are likely to see from the tightening in financial conditions that's occurred since late 2021 2021, and we're estimating about a 2 percentage point hit to growth. So 2 percentage points is a lot because it, the trend growth rate of the US economy is probably a little bit below 2%. So if you just looked at the impact of financial conditions, you would say that should give you, 0 or slightly below 0 for GDP growth, and so potentially a recession. However, I think there's another important driver of real GDP growth, which looks a little bit better, namely what's happening with real household disposable income. Real household disposable income was extremely weak in the first half of 2022. In fact, if you look at the year-to-year change in real disposable income, it was the most negative in post-war history because, number one, fiscal policy normalized. You had all these transfers in 2020 and the first half of 2021 that subsequently rolled off, and you had extremely high headline inflation with this massive surge, especially in food and energy prices. And that meant a big drag on growth from real disposable income. Going forward, that drag from real disposable income is likely to be much smaller. And in fact, we're looking for real disposable income to increase as food and energy prices in particular, have normalized to some degree, and we're no longer getting this sizable drag from fiscal support rolling off. So in our forecast, we actually have plus 3% for real disposable income over the next year. In that sort of environment, our best estimate remains that growth will be slow but positive. About 1% is our forecast. Now, of course, there is its very sizable probability or possibility that we will actually see a recession. And while most forecasters still don't have a recession in their baseline forecast, some do, and we would say that the risk of recession is perhaps 1 in 3 or a little bit more over the next 12 months. So then the question is, how deep would a recession be if we did see a recession? And I think there are basically 3 reasons why a recession in this environment would likely be less deep than historic norms. And the first one is that we're starting from a labor market position where there's such a large amount of demand for labor. Job openings are at very high levels. And again, our jobs workers gap is very large. That basically means businesses are still very aware that they were very recently, or maybe still are, in a labor shortage environment. And historically, when you've started from those kinds of developments or those kinds of situations, the impact of a reduction in real GDP growth on employment, it has been smaller than normal. And this is what you see on the screen in front of you is is the result of an econometric analysis that our team has done, which basically bucketed the jobs workers gap observations into 5 quintiles and then ran a regression of the impact of a 1 percentage point hit to GDP growth, or in our current activity indicator, which is a monthly equivalent to GDP growth, and then looked at the impact on employment growth. And when you have a very high jobs workers gap, very high levels of job openings, the impact is significantly smaller, which basically means that there is less of an impact, less of a multiplier effect, negative multiplier effect through the labor market, and that probably means a smaller or a milder recession than under normal circumstances. Second reason for why a recession probably would be relatively mild is that private sector balance sheets are quite healthy. The private sector has been running, significant financial surpluses over the past several years. So there's a lot of cash on private sector balance sheets, and history shows that when you have seen a period where the private sector has run significant surpluses, recessions tend to be less frequent and also likely milder. And then lastly, and this is really just a reminder that we're still in a post-COVID environment where some of the weakness that we're seeing in consumption of goods is likely to be offset, which certainly could go further and probably will go further. It's likely to be offset by stronger private service consumption. And there's still quite a lot of room if you look at recovery post-COVID in a number of areas, such as in a number of areas on the service side of the economy. And I think that probably also will limit the depth of a recession. Now, what about Europe? Let me talk briefly about Europe. In some ways, in some areas, Europe is seeing less of a drag on growth than the US. Fiscal policy did not tighten to the same degree that fiscal policy in the US tightened. And financial conditions in Europe have actually not tightened as much as they have in the US. And I think that's one reason why the European growth numbers in the first half of 2022 were actually better than the US growth numbers. I mean, it's hard to sort of believe given everything that's gone on with the war, but European growth was actually positive in the first half of the year, while the official US GDP numbers were negative. However, Europe is obviously being hit much harder by the energy shock, because they're being hit not only by higher oil prices, but also by reduced supply of natural gas, the drying up of natural gas out of Russia in the wake of the war. You can see that in terms of just the headline inflation numbers. If you take the blue line here, takes the US PCE index rather than the CPI. The CPI would be higher, but not as high as the Euro area or UK numbers. So that is, of course, a direct negative impact on household budgets. We also have a European economy that is, very exposed to natural gas consumption. I would say especially Italy and the UK run to a significant degree on natural gas. And then Germany, especially the industrial sector, is very dependent on natural gas. And so the spike in natural gas prices is likely to put Europe into recession. And we're starting to see that in the in the industrial production numbers, and we're seeing it very clearly in business surveys, especially in the industrial sector, and again, especially in Germany, as you can see on the right-hand side here, where the business climate, according to the Munich IFO Institute, expectations are at levels that are well below where they were either during COVID in the spring of 2020, or for that matter, in the global financial crisis in 2008. So there's clearly a recession coming. Hasn't really shown up very clearly in the data yet. The GDP numbers have still been positive, but Q4 is likely to be negative. And then we expect negative numbers in the early part, first half of next year as well. I think the depth of the recession is going to depend to a significant degree on what happens with the weather. If it's a cold winter, I think it's going to be a deep recession. If it's a more milder winter, then it's likely to be a mild recession or a more moderate recession. But recession is definitely our baseline view. Now, despite this downturn that we're seeing in the real economy, we're expecting further increases in short-term interest rates. We have 75 basis points from the European Central Bank later this month, and we're expecting a further 75 basis points in December, although that could be 50 basis points, and then a final 50 basis point move in the first quarter. And I think one interesting observation, especially for central bankers, is just how much the European Central Bank has focused on inflation. This is a simple word count from central bank statements, Fed, Bank of Canada, Bank of England, RBA, and the ECB this year. And 90% of all economy-related words in ECB statements so far this year have been about inflation, whereas it's been a much more even split between inflation and growth or labor markets in the other central banks. So clearly, the ECB doesn't look likely to blink and stop hiking because the economy is going into recession. Lastly, just a few words on China. We have had a negative view on the Chinese economy, as you can see on the right-hand side. This is our forecast as it's evolved in 2022 for 2022 GDP growth. And we think that China is going to continue to be in a tough position through the next few quarters, basically because the zero COVID policy that Xi Jinping implemented is unlikely to be taken away anytime soon. We're not expecting a fundamental change in that until the second quarter of next year, given the still very low vaccination rates of the Chinese population, and the fact that intensive care unit beds are still are relatively low. The supply of ICU beds is relatively low. So China is not well prepared for a major COVID outbreak, which probably would be, which we would probably see on the back of a broader reopening. So don't really expect reopening until next year. And in the meantime, I think it's still going to be stop and go with occasional lockdowns that lead to a sharp decline in economic activity, followed by a reopening that leads to a sharp rebound. But I think it'll be a stop and go environment. Now, once we get out of zero COVID, maybe in the middle of 2023, I do think there's going to be a substantial pickup in growth for a period. We estimate that Chinese GDP is about 5% below the level that we would have without any COVID impact. So once the COVID impact really recedes into the rearview mirror, a significant chunk of that 5% is probably going to be made up, and that's a big increase in GDP. However, we don't think over the much longer term, we're not looking for anything like the growth rates that we had in the past 20 or 30 years, in part because the contribution of the housing sector is likely to be negative for an extended period. And we think for a combination of reasons, demographic decline and an end to the urbanization process, we're likely to see a long-standing decline in property investment and construction of new apartment buildings, and probably continued declines in house prices as well. So, our best estimate is that property contributed something like 1.5 percentage points to growth prior to the pandemic every year. And over the next several years, we're expecting kind of -1 percentage point or so, and therefore a drag on growth. So in that kind of environment, it will be hard to get back to anything like the sort of 6 or 7% GDP growth numbers. And we would expect something more in the 4 to 5% range, even after COVID recedes into the rearview mirror. And that is, obviously a very different environment in coming years. So I'm going to stop here and maybe open it up to questions and discussion.
Okay, thank you for your presentation, Jan. I think it shows the complete picture of the economic situation for the principal economies of the world. To begin, I suggest that we talk a little about the title of your presentation, Disinflation Ahead. I believe that inflation is going to slow down, but the two important questions are, first, it's come in the middle of a controlled recession or a deep recession, maybe a crisis. And second is, how much can some supply factors about which there is still uncertainty affect the trajectory or duration of this disinflation scenario? For example, the gasoline price with the OPEC announcement. You say, for the case of the US, you give arguments against deep recession, excess labor demand, healthy private sector balance sheet, and post-COVID rebalancing continues. Maybe this suggests then that we could be facing a soft landing.
In the US, that is our expectation, yes. I mean, whether it's a soft landing or a softish landing, it could be a mild recession. I think that's certainly very possible. But I do think that with the supply factors helping somewhat, I think we could see a soft landing. Now, if the supply factors, energy prices, for example, again become a lot more challenging, then I think the probability of a soft landing is likely to go down. So if we had a renewed increase in oil prices to, the $120 a barrel kind of range, and if gas prices went back up from $3.80 now, $3.80 a gallon on average in the United States, back up to $5, I think then a soft landing would be much harder. I don't think it would change the ultimate outcome in terms of where inflation goes, because I think that is ultimately going to be driven by monetary policy, but it would be more painful to get there. And it probably would be a recession. I think there's still some reasons to think it might not be a very deep recession, but it would be a recession in that case, probably. And there are other supply side factors that are important. I think we're seeing, improvement in some of the supply chain issues. Could that change in, response to geopolitical conflict? I mean, the one that a lot of people are focused on, of course, is a conflict between the United States and China over Taiwan. Taiwan is extraordinarily important in terms of global supply chains. So that would, potentially give us even worse problems than the supply chain issues we've had. So the risks to this assessment are definitely tilted to the downside. And there's a range of things that could make it worse. And we'll be focused on those developments and change our forecast accordingly. I think what central banks can basically do is, focus on aggregate demand and bring aggregate demand, into a more sustainable level, their instruments don't really work very well on the supply side of the economy. There's nothing that the Fed can do or any central bank can do to, bring, say, semiconductor supply chain issues resulting from COVID in Asia, or, maybe military concerns about military conflict or blockades. Nothing that central banks can do about that. What they can do is bring labor demand back into line with labor supply, because labor demand is, still well ahead of labor supply, and that is very much a job for central banks.
Okay, for this scenario, maybe the monetary policy tighten it just enough, and say this one because despite making some mistakes from Federal Reserve and mischaracterizing the inflation like transitory and then acting late, you think that there's still credibility in the Fed?
I do. I mean, clearly this was a big forecast error, which the Fed made, and many private sector economists made. And, I would definitely issue a mea culpa here. I mean, we missed the extent of this inflation upturn. The Fed missed it. The consensus forecast, if you look at the, early part of 2022, missed it. There were some high profile economists who were much more forward looking, and Larry Summers is obviously, a very prominent one, but there were some others as well. But the majority of forecasters were well behind for a variety of reasons. I think the more excusable ones, when I look at our forecasts, I don't feel so bad about missing the supply side. I do feel more self-critical about missing the demand side and missing the extent of the labor market overheating. And we have sort of adjusted some of the measures we look at in as far as labor market overheating is concerned. But yeah, clearly the Fed got it wrong. And then I think even after they had kind of recognized that they were getting it wrong in the fall of 2021, it still took 6 months before the first rate hike actually occurred. And that was in part because they had this process where they said, we first need to finish QE before we can hike the funds rate, which actually, I mean, there wasn't any particularly good reason for it. They could have hiked the funds rate even while they were still doing QE, or they could have stopped QE much more quickly. That probably would have been, that would have been quite easy to do. So, plenty of mistakes. That said, do they still have credibility? I mean, for that, I would look at market measures, or I would look at inflation expectations measures. They didn't spend much time on inflation expectations here, but they're still very anchored. I mean, long-term inflation expectations, according to the University of Michigan, 5 to 10 year is at 2.7%. Now, 2.7 is higher than 2, but historically that number has always run higher than actual inflation. And 2.7 in this 5 to 10 year measure is actually pretty consistent with 2%. Professional forecasters are still expecting 2% over the longer term. And of course, the bond market is pricing inflation index bonds and nominal bonds in a way that implies about a 2% longer term inflation expectation. So, despite the mistakes they've made, I think they still have credibility when it comes to people believing that they're going to get back to the inflation target. But of course, they need to deliver, right? I mean, you can't take that credibility for granted. And so they're, making an effort, and I think a pretty aggressive effort, to deliver on the credibility.
You mentioned the quantitative easing. Do you think that unconventional central bank policies like quantitative easing are here to stay and will be new normal? If not, what will be the challenge for monetary policy if they decide to end the quantitative easing?
I think it will remain part of the toolkit, but only once the policy rate hits zero, I think it's an extension of conventional monetary easing with other means. So you would have to see a recession and downturn in inflation that was sufficient to bring, say, in the US, the federal funds rate back from 4.5% or 5% or wherever we end, back down to zero. And there would then still have to be a need for additional monetary stimulus. Those are pretty demanding conditions, because it probably would mean inflation would have to be pretty far below 2%, and the economy would have to be in a deep recession. So I'm not forecasting it. I think we'll see some monetary easing as we go into maybe 2024, 2025, but we don't have the funds rate go back down to zero, and we don't have a new QE program. But I do think that once you've moved the funds or the policy rate down to zero, it's not super attractive to make the nominal policy rate negative for a variety of reasons. Of course, you can, and it's possible to make it negative. You might still get some stimulative effect, but probably not a lot. And then I think quantitative easing would be more attractive. So it certainly could come back again at some point way down the line. I can't hear you at the moment. I don't know if you're on mute or if something went wrong with the audio.
Okay, can you hear me now?
Yes, I can now.
Okay. I want to take this opportunity to ask a question from the audience, and it is, do you believe that the outside factors such as current geopolitical conditions, recession in the Eurozone, economic crisis in emerging economies could affect monetary policy in the US?
A great question, and obviously on many people's mind, especially as we go through this round of IMF meetings. I think probably only really to the degree that it poses a risk to the US. Unfortunately, from the perspective of non-US central banks, the Fed's mandate comes from Congress, and Congress didn't say anything about global conditions. That said, if there were really substantial financial instability that washed back into US financial markets, tightened US financial conditions further, then of course the Fed would take that into account and might do a little bit less in terms of rate hikes. I don't think we're close to that, but so I think, unfortunately, I think things would need to get worse before they could, perhaps get a little bit better on account of easier policy in the US. Also important to note, there's a debate about all of these things within the Federal Open Market Committee. Some people are more focused on global developments than others. I would say Vice Chair Brainard is well known to pay more attention to global developments and probably weight them more heavily in her assessment of the monetary policy outlook. She gave a speech on Monday that leaned a little bit more in that direction. But at this point, I would say she's probably in the minority, and I wouldn't really expect any significant impact.
Okay. About the same theme of monetary policy, we know the monetary policy shouldn't behave like a water vane driven by economic news. It's not like a light switch. However, the next year is not going to be easy for the global economy. And one of the big questions about the path of monetary policy rates is what must happen to see a decrease.
A decrease in policy rates?
Yeah.
I think, well, if you look at the FOMC, and the FOMC minutes yesterday, for those of you who read them, they basically say when they are confident that inflation is on its way back to 2%, when they see clear signs of inflation returning to 2%, not inflation doesn't have to be at 2%, but they need to be confident that it's going there, then they would cut the funds rate. And you could also look at the summary of economic projections, which gives you a range of views on where the economy is going to be and what's going to happen to the funds rate. And they're showing 75 basis points of rate cuts in 2024, with the unemployment rate at 4.4%, so about a percentage point above where we are at the moment, and inflation at the end of 2023 at about 3%, a little above 3% for core, a little below 3% for headline. So that's sort of an environment where the economy is weakened significantly, and it looks like there is, a path back to maybe 2% or something close to 2%, but they're still actually significantly above. So that would be my guess. If we see very clear signs that things are moving back to a better place, and the funds rate is coming from very high levels, and it's then going to be cut. In other economies, obviously, you're going to have different answers depending on the starting point of the policy rate, or the peak policy rate relative to the central bank's estimate of neutral. And I would say in the euro area, for example, maybe they get to 2.5 or 3%. That's not that far above neutral, so I think they'd probably be a little bit more reluctant to lower rates. In many emerging economies, of course, we're moving way above neutral, or have already moved way above neutral. And so I think there the hurdle for delivering some cuts is probably a little bit lower, just because you're so far away from neutral.
Okay. As with the Eurozone case, in this case, the Eurozone, the inflationary context seems to be different. The IMF said the energy crisis is not a transitory shock. The geopolitical realignment of the energy supplies in the wake of the war is broad and permanent. What is the probability of a stagflation scenario in the Eurozone?
I think there's a bigger risk, obviously, because there is a more substantial shock. That it is a permanent shock. I totally agree, it's a permanent shock. So Europe needs to adjust to the much higher level of energy prices, because while they can import more liquefied natural gas, for example, that is always going to be much more expensive than piping it from Russia. And I think in the meantime, the central bank basically needs to focus on stabilizing inflation expectations. And that's one reason why they're more focused on inflation and also more worried about inflation expectations than perhaps other central banks. I think the Fed at the moment is not particularly worried about it, because the indicators are pretty clearly that expectations are not an issue. So in theory, there is a risk of stagflation, and it probably does require a deeper recession. The central bank needs to impose a deeper recession in order to effectively force the adjustment in the private sector to these much more constrained energy supplies. And if they don't do that, then I think stagflation could be a bigger, longer-term risk. But again, I don't really think it's going to happen, because I don't think the central banks are going to let it happen.
Okay. And the last question about Eurozone. The increase in interest rate implies a higher borrowing cost for household and government. Some central banks have decided to continue or increase the purchase of government bonds to try to mitigate the significant increase in financing cost. You think, are we facing fiscal dominance in Eurozone?
I don't. I think that, you know, I think there's obviously a significant risk if you were to have, you know, a big increase in spreads in Italy on the back of, you know, policies that markets viewed as, you know, perhaps not compatible with long-term fiscal solvency. I do think that that is a risk. There is a question, I think, around, you know, what the hurdle would be for the ECB to step in and, you know, effectively cap the level of spreads. But I think there would be, you know, a significant desire to effectively impose some type of conditionality on Italy and, you know, other maybe member states that had, you know, significant fiscal issues, but Italy is obviously the one that everybody's focused on. So it could put the ECB in a difficult position. I don't think, though, that they would let that they would be willing to let inflation run at significantly above target rates in order to help the fiscal authorities in one member state. I don't really think that that is a likely outcome at all.
Okay. About China, is a question from audience. How large do you see the risk of a real estate crisis?
Well, it depends a little bit on how you define a real estate crisis. I mean, our China economists are projecting a decline in housing starts or new apartments built from 20 million in 2018 to 6 million in the middle of the century. That's not a crisis because it's an adjustment over a very long period, but it's a massive adjustment. And it's got a big impact on GDP growth. You know, probably the swing is worth 2 or 2.5 percentage points from plus 1.5 to minus 1 over the next couple of years. I think a crisis in the sense of a liquidity crisis and a Lehman moment for China, I think that's highly unlikely because I just don't think that the authorities would be willing to allow it. Can we see, you know, substantial increases in bad loans and a drag on the economy from, you know, a hit to the financial system? Yes, we can see that. I think that is a risk, but the sort of financial crisis that we've seen in Western economies, especially around 2008, I think is very unlikely.
And finally, the last question. Under this environment, what is the main principal risk for emerging markets and how to deal with this risk?
Look, I think the biggest risk is probably still from, you know, worse inflation outturns in the advanced economies that lead to, you know, ongoing upward pressure on US rates, which is always more painful for emerging economies. I think emerging economies are in a relatively better position than maybe other advanced economies like Europe because they got started so much earlier on normalizing monetary policy. And while, you know, the Fed and the ECB were kind of missing the big picture in 2021, you know, fortunately, central banks in emerging economies saw the ball more clearly. And I think that is putting them in a better position. But it doesn't guarantee, of course, that you can't be hit by the fallout from monetary normalization in Europe. But in Europe, in the US, you know, obviously, especially in the US. So I think that unfortunately is still going to be with us, at least for the next several months.
Okay. Thank you, Jan. Unfortunately, the time is up. Thank you for these extra minutes. Thank you so much for accepting the invitation. I'm sure that this session was very useful for the entire audience. Vielen Dank.
Vielen
Thank
Dank.
you so much.
Very much, Diana. It was great to have this discussion in addition to the presentation. And also thanks to everybody for participating and sending in such great questions.
Thank you. Thank you to you. And thanks all for your assistance. See you in the next virtual session on October 19 about investment by factors investing in fixed income. So thank you and bye.
Bye-bye.